Let's now move on to the trade on this Friday. And before we get into the charts, let's take a look at what traders are watching out there today. US President Donald Trump threatening to slap a 200% tariff on wine, cognac and other alcohol imports from Europe, opening a new front in the global trade war that has roiled the financial markets and raised recession fears. Top US Senate Democrat Chuck Schumer said he would vote to advance a stopgap funding bill, signalling that his party would provide the votes to avert a government shutdown. US producer prices, they were unchanged in February for the first time in 7 months, while fewer Americans filed claims for unemployment benefits last week, pointing to a stable economy that may well allow the Fed to keep interest rates steady next week. And benchmark copper prices in London retreated from 5-month highs on concerns about global growth, dialed by the impact of US tariffs inflating metal prices, while tin prices spiked to a 32-month peak after a mine in Congo closed. And gold prices, have we just spoken about, raced to a record high within touching distance of the key milestone of $3,000 an ounce, with momentum driven by elevated tariff uncertainty and bets on monetary policy easing by the Federal Reserve. Well, let's get to the charts and how this is all playing out amidst this uncertainty sparked by Donald Trump's trade policies. And to get across it, Elliot Spivak joining us from Tati Live. Elliot, welcome back. Good to see you. Now, we only have to take a look at equities to see how this is playing out for sentiment at the moment. It's extremely negative, very sharp sell-offs. In fact, the Nasdaq and now the S&P in correction territory.
Very good to be here, Andrew. And you're absolutely right. I mean, the first chart I have for you here, just to kind of set the stage here, is the S&P 500. And of course, it looks absolutely awful. And it, as you've just pointed out, it is this uncertainty around U.S. trade policy that's really hit the market. And moreover, it isn't just that the markets have just woken up and decided, now we know that the administration intends tariffs. No, obviously that's been known for some time. Rather, it's the execution and what that execution has done to business confidence and consumer confidence. All of this really kicked off in late February when we saw a second consecutive month of S&P Global PMI data showing a very steep slowdown in the service sector, just around uncertainty, businesses holding back capital, waiting for the dust to settle. Now, we've already sold off into this congestion area that we saw give us all kinds of chop from June through about September of last year, right around that 5,500 level on the S&P. So I wouldn't be surprised if we get into a little bit of a sideways sort of chop here, but we do have the bearings of a range. So in order for you to really think that there is some sort of a recovery on the way, you'd have to get back above that 56.65, 57.21 area. And the downside objective you might look at from these levels around 53.30, 53.90. So you have your clear bearings here for the extremes in this space now. So perhaps if the markets get a little bit more optimistic ahead of next week's Fed announcement, then we could see a little bit of a backfill toward 5,700 before more selling is going to occur here.
So that's what we're seeing play out at an equity level. Ilya, now just taking a look at what we're seeing in fixed income, and there obviously bets are increasing as far as the prospect of further rate cuts by the Fed, particularly if the US, of course, were to fall into recession. Look, no chance priced in for a rate cut next week at the meeting, but by June, it's now up to 100% chance.
That's right. So as we look at, in particular, what's going on at the long end of the yield curve here, we see this very steady climb in the 30-year bond that, of course, speaks to falling interest rates at the long end of the curve, reflecting this idea that the market increasingly is demanding interest rate cuts around these recession fears. But of course, likewise, hearing Jay Powell and other officials, but of course, most critically, the Fed chair, he spoke just last week and said, look, we don't need to be in a hurry to cut rates. The economy is fine despite all of this uncertainty, we have the benefit of time to wait and see and find out how all of this shakes out. From the market's perspective, of course, they don't have the benefit of time and they need to be cutting now. So we don't currently see that the Fed is going to, as you just mentioned, change course next week, and probably not at the meeting after that. But sometime around mid-year, the cuts begin, and the markets now see 3 of them this year and another one next year. That's a little bit richer than what the Fed itself was anticipating, at least in terms of timing. It only thought that there's 50 basis points in cuts this year, and the markets now want more. We see the bond here start to anchor against former resistance become support at 115.27, 116.07 or so. We can see this very steady stair step higher. And so if we, for example, were to get soggy U.S. consumer confidence numbers out of the University of Michigan here, you could get the next leg higher. Those numbers do just over the next 24 hours. And it's difficult to imagine how, given consumers' concern over recent months with some of this tariff uncertainty and how that's not become resolved, that they don't feel some doom and gloom again. The expectations already point lower on sentiment. It could yet overshoot. That could give us a lot more rate cuts added into the back half of the curve here.
Let's, Ilya, now switch to currencies, how this is all playing out. Now, of course, over the past year or two, we've seen a very strong US dollar, reflecting essentially that US exceptionalism. That, of course, has now been brought sharply into question. The US dollar is coming off, and we're seeing the euro actually rise quite sharply. Not the least, of course, seeing a lot of spending in the EU zone at the moment.
That's right. So as ever, currencies are a great barometer on relative yield advantage. And of course, last year, especially in the second half of the year, with the Eurozone anemic, with China anemic, and the U.S. growing very sharply, in particular thanks to a very buoyant domestic service sector, those yield spreads were shifting in favor of the dollar. And we can see that as the Fed sounded dovish from September, the market said, wait a minute, there's no way that this makes any sense. Yields shot higher. And of course, the dollar shot higher. We can see that very steady decline in the euro from about 112.50 down to 102. That's a huge move. And of course, what we've seen since then, since the beginning of this year, is those yield spreads have started to shift the other way because the markets are worried about recession and think the Fed's going to have to do more cutting. And the euro has had a particularly fine time of it because on their side, all of this war of words around Ukraine and NATO has meant that for the first time in decades, Europe has really embraced rearmament. And it's embraced it with, interestingly enough, France, the UK, and Germany all of one mind. So we have a situation here where there's a lot more fiscal impetus that seems to be coming down. That's probably going to mean fewer ECB rate cuts, just as the markets want more of them from the Fed. And of course, against that backdrop, the euro has absolutely soared. We're pushing up toward that critical 110, 109.50 area where there was so much congestion before. If we break through it here, for example, as we just discussed, if consumer sentiment gives us more rate cuts into the outlook, we could really get back to the 112 area in a hurry.
Ilya, great to get across what you're seeing on the charts right now. Thanks for joining us in Tasty Live.
Always a pleasure, Andrew.
And that is the trade for this Friday.